Ladies and gentlemen, hello, good morning, or good afternoon if you're in Australia. Welcome to the Colliers webinar. The subject is Logistics and Industrial Sector and Technology Occupiers Leading the Way in 2021. Just before we start, please let me mention a couple of housekeeping items. Everybody apart from the presenters will be muted for the duration of the call. However, please ask questions at any time during the call. You can submit questions using the Q&A tool on the dashboard, and we will collect those questions and try to answer them towards the end of the webinar. I'm Andrew Haskins. I am the head of Asia Research for Colliers. My colleagues are Rakesh, Kunhiraman, and Joanne Henderson. Rakesh and Joanne, why don't you introduce yourselves, please?
Hi, good morning, everyone. I'm Rakesh Kunhiraman, and I lead Occupier Research for Colliers across Asia, and I'm based in Singapore. Over to you, Jo.
Thanks. My name is Joanne Henderson. I lead the Australian research team out of our Sydney office.
Great. Thank you, Rakesh. Thank you, Joanne. Without further ado, please let's get started. So let me go to the first slide of our presentation. So in this webinar, we will discuss our forecasts for the office and logistics and industrial sectors for 2021. We will also talk about 4 key themes dominating markets for this year and beyond. Regarding the office sector, we see recovering demand, but also pressure on rents and rising vacancy. Popular cities should see a gradual recovery. That is markets like Singapore, Sydney, Melbourne. In logistics, in the logistics and industrial market, in contrast to office, most Asia-Pacific markets remain in firm expansion mode, with rents steadily rising and investment popularity increasing. What are the 4 key themes? And we shall go into all of these in more detail. China +1 strategy. Most multinational companies, MNCs, will stay in China, but seek new markets to cut costs and spread risk. Technology occupiers. Asia-Pacific technology occupiers led by large Chinese groups will increasingly dominate office leasing markets. Flexible workspace. We expect flexible workspace operators to follow occupiers and look outside traditional CBDs. And finally, sustainability will start to drive property investment and leasing decisions. So that's a summary of everything. Let's discuss things in a little more detail, starting with the outlook for office markets. As you can see, on the left-hand side of the slide, what you see is a traditional property clock showing the position of markets in the property cycle. You can see that all but 4 of the 19 Asia-Pacific city office markets that we follow closely, all but 4 currently favor tenants. So it's a good position, a good time to be an occupier right now. Looking at our aggregate forecasts on the right-hand side of this slide, we expect demand of 4.82 million square meters in aggregate across the region this year. That will actually be up 96% compared to 2020, so that's a strong recovery. However, supply is also going up. We see supply at 7.82 million square meters, that's 1.6 times demand. Supply will stay high in 2022. It will start to go down in 2023 in most markets, although Tokyo, Shenzhen, and some Indian cities will stay high even then. And it's this increase in supply which will push down rent. We expect rents to fall in aggregate 6%, or 6.1% to be exact, this year. However, rents in Singapore and Auckland should turn upwards in 2021, while those two cities, plus Bengaluru and Melbourne CBD, should see average rent growth of over 2% per annum over the next 5 years. Now, with supply rising, of course, vacancy also rises. We expect vacancy to peak at just over 15% before falling to 13.3% 5 years from now. Now, let me just talk about the logistics and industrial market. This is very different from the office market. As you can see in the property clock on the left, nearly all markets in Asia Pacific currently favor landlords. The only market that we would say is tenant favorable is Hong Kong SAR. You know the main drivers of growth in this sector: e-commerce, cold chain, new warehouse designs. We'll talk about these things in more detail later. But with demand strong, rents are now picking up. We expect rents to pick up in China, for example, this year, with 3% growth in Shanghai. If you look at Australia, after falls of 3 to 5% last year, effective rents in Melbourne and Sydney should rise 1 to 2.5% in 2021. And in the biggest logistics and industrial market in Asia, which is China, we think it's quite likely that cap rates for Chinese logistics assets will fall below office cap rates within a few years. Let me just move on to the first of our major themes. China plus one strategy. Now, China has a huge domestic market and high long-term growth prospects. These factors provide sufficient room for expansion by multinational companies, MNCs, so we don't expect large-scale withdrawals from China by any means. However, trade tensions have driven MNCs to be present in at least one market outside China, and there are all sorts of reasons arguing for this: risk diversification, cost advantages, access to new markets, tax and other incentives. We think the China plus one strategy will boost demand for industrial space, in particular in markets like Japan, Taiwan, Vietnam, India. On the right-hand side of this slide, you can see some examples of manufacturing companies, in particular companies like Samsung, Foxconn, Taiwanese computer manufacturers looking for manufacturing space in their home markets or in other markets, particularly in Southeast Asia. What does this mean? Well, I think demand for industrial space in particular should persist in China, Japan, Taiwan, Vietnam, India. From the perspective of building owners, industrial property prices in particular should stay firm. Office capital values, however, are less likely to rise in the near term. Now, at this point, I'm going to bring my colleagues into the discussion. Let's talk in more detail about China plus one strategies. Rakesh, are there any sectors or industries that you think are focusing on China plus one strategies in particular?
Andrew, reiterating some of what you've just covered right now, China plus one is actually a business strategy, and companies that are taking this approach is and thinking of moving their operations to a location outside of China is because they want access to new markets. There's rising costs in China. They want to diversify their basket. They want to diversify their risks and move out of China. And lastly, to a certain degree, the tax incentives that they had are now starting to disappear. So, which is one of the main reasons why we are seeing companies adopt this strategy. Now, this strategy is not really sector specific. I mean, for instance, a recent report by the ASEAN Macroeconomic Research Office shows that in 2018, the total investments from China into the ASEAN region was about 150 billion. They expect this to rise to about 500 billion by 2035. Now,
that's US dollars, isn't it?
This is in US dollars. So what this shows is that this strategy is not just limited to foreign companies or multinational companies based in China. It also applies to Chinese companies who are looking to broaden their horizon. So that is what we see the China Plus One strategy to be.
Well, that's an important point, Rakesh, and that's something to which we will return. The question of Chinese tech companies moving to other markets. But let's now ask the question: what do China Plus One strategies mean in terms of demand for logistics and industrial space in particular, because those sectors will benefit more than demand for office space? And it's perhaps just worth highlighting at this point that according to Colliers' recent global investor survey, 31% of Asia Pacific investors see office as the top asset class to target this year, but logistics and industrial are only just behind on 25%. Now, Sydney and Melbourne across the region are two of the markets with the greatest stock of logistics space, 12 to 13 million square meters each. Joanne, what do you are the kind of logistics assets that will yield the best returns for investors?
Thanks, Andrew. Look, at the moment, it's all about any asset with a food supermarket-based covenant is in high demand. So, online food shopping has been increasing in Australia, especially through the COVID period. I think there's probably been an acceleration of that due to COVID, a trend that was happening anyway. So definitely, cold storage is a big is a lot of demand going towards cold storage at the moment in Australia, particularly as only around 2 to 3% of the current market is cold storage. Also, anything which is in major growth corridors, close to infrastructure, and considering that there's about 30 billion in capital looking to be placed within the industrial sector in Australia, there's investors are being very aggressive to secure sort of high quality assets.
Thank you very much, Joanne. Shall we move on to the next topic of discussion, which is technology occupiers? Now, if you look at this slide, you can see Chinese tech groups currently occupy 2 million square meters of space for company headquarters in Chinese cities, and they represent 10% of prime office stock in those markets. We think that Asian technology occupiers led by Chinese groups will make 20 to 25% of demand for office space across the region between now and 2024. As competition increases, occupiers will need to focus on workplace strategy for talent attraction and retention, while investors should find opportunities in popular technology submarkets. China, Southeast Asia, and India are all likely to be key destinations for technology sector investment. Let me show you just one more slide on this topic. You can see on the left-hand side of this slide the stock market capitalization or estimated valuation of leading US and Chinese IT and internet groups as of the end of 2020, in addition to the American names, Apple, Microsoft, Amazon, you see lots of Chinese names, Tencent, Alibaba, ByteDance, Xiaomi. The Chinese companies make up 23% of this total. And this is why, as we said, Asian tech tenants, we think, led by the Chinese, will lead demand for office space across the region, driving rents, driving incentives, driving deal structures. What does this mean for investors and developers? They will continue to focus, we think, on key technology locations like Singapore, Sydney, Melbourne, Bengaluru, Hyderabad, and on key submarkets within those major cities. Now, let me put some questions to my colleagues. What does the expansion of Asian tech occupiers mean for non-Asian tech occupiers? Will they continue to grow, and how much will they account for leasing demand? And this question, by the way, is very relevant not just to Asia, but also to Australia, because Sydney and Melbourne are popular occupier centres. And Sydney, according to a recent global survey, is the most popular investment location in Asia Pacific. But let's start with your view, Rakesh.
Sure, thanks, Andrew. To put this into context, the technology sector has been leading leasing demand over the past decade. Within in the last 5 to 7 years, we've been seeing this sector accounting for about 30 to 35% of gross leasing demand. And at that point in time, they were led by Western tech operations. What we've noticed over the past few years, is that there is a shift towards Asian companies, particularly the Chinese giants that you've just named. And so one of the key factors is that the Asia Pacific region has the largest population that's connected to the internet. However, the penetration rates are actually lower than what we see in developed markets. So there is a huge potential for growth. And what we are seeing is that homegrown tech companies are creating tailored products that is targeted to this growing market. And this is the reason why we feel that the demand for space will come from Asian tech companies. Just as a highlight, recently a recent report by Dealroom actually indicated that the size of the startup ecosystem within the ASEAN is about just under 110 billion US dollars. So that shows you that the kind of the size of the market and where the market is headed. So what we're saying is that the growth will be led by Asian tech. It does not mean that established Western organizations will not grow, but the pace of growth would be led by Asian companies.
Thank you, Rakesh. Joanne, how do you see the situation in Australia?
Yeah, look, technology occupiers have driven a lot of pre-commitment activity, particularly in Sydney and Melbourne, and also are driving a lot of occupying and helping to regenerate areas on the fringes of our CBDs. So Sydney and Melbourne have not really had any established technology hubs, unlike other cities globally, where there is, innovation hubs, technology hubs, which bring all of those technology occupiers together. In Sydney and Melbourne, they've been much more spread out into different areas, but we are seeing trends of this starting to happen in the government. This is a focus for our government. So looking at Melbourne, we do have the Richmond and Cremorne Innovation Hub, which has sort of really had a regeneration. It's in a city fringe location, and there's a lot of investment into that area by the government. It has been highlighted by the government. Their spending in Melbourne is about $12 million for a new centre of innovation and technology and high-skilled jobs. At the moment in that area, there's headquarters by MYOB, the REA Group, Car Sales and Seek. And there will be future development and demand driven by technology occupiers. In Sydney, we do already have tech companies have been driving demand. Sydney is traditional finance occupier driven, so about 25% of our occupancy at the moment is from finance companies. We do see that over the next 10 years shifting to at least equal or maybe more from technology, professional scientific services companies, and there is a big rejuvenation of the southern end of the CBD. So there is Tech Central, which just lies outside the CBD. There's about 25,000 workers that will come into that area to form part of the Central Precinct Renewal Program. And at the moment, we have Atlassian that have anchored there to have their headquarters. So really, technology occupiers are really driving that regeneration of areas that were traditional, potentially industrial, not a lot of high-rise or large occupiers would go to those areas, but there's a real strong uplift in demand for that, and technology will drive that and particularly drive our net absorption.
Thank you, Joanne. Now, Rakesh, Joanne has just mentioned that Sydney and Melbourne don't have a tradition of technology hubs, but they are emerging. But Asia does, of course, have established technology hubs. Which do you see as the markets and the sub-markets growing in significance now?
Sure. So we actually did a study on this last year, and this is the Colliers Tech Jewels study that we've done. And at that point in time, we identified locations such as the Outer Ring Road in Bangalore, Shenton Way, Tanjung Pagar in Singapore, Zhongzhoukan in Beijing, and these locations continue to be the I'd say the hub for tech organizations within the region. But we've also identified locations like Gachibowli and the High Tech Park in Hyderabad, the Nihu and Nanang business parks in Taipei, Causeway Bay and Quarry Bay in Hong Kong, and Shibuya in Tokyo. So these are the markets that we are looking at as emerging. And in a recent report by Startup Genome, they actually identified the markets that I just mentioned as some of the emerging, tech startup hotspots within Asia.
Interesting. Just showing my age here, I can remember when Tokyo really was the world center of electronics. It lost that crown, but maybe it's coming back. All right, let's move on to the next subject, or the next theme rather. Flexible workspace. 1 year ago, many people were predicting that flexible workspace would be killed by COVID-19. That doesn't seem to be happening. We think flexible workspace is the future. Why? Tenants, we think, will use flexible workspace for short-term leases and expansion opportunities to avoid capital expenditure. We expect partnerships between occupiers and operators as occupiers look to reduce excess space. Flexible workspace operators, we think, are likely to follow occupiers and seek opportunities outside traditional CBDs. And it's worth highlighting here, many or most Asia Pacific cities, Beijing, Seoul, Sydney, all the large Indian cities have viable office districts on their fringes. For occupiers, flexible workspace meets demand for offices closer to residential areas where their employees live. For owners, the trends that we see may well mean that prices of decentralized and business park offices outperform prices of CBD office assets. Now, again, let me bring in my colleague Rakesh. Joanne, are there any landlord-operator partnerships that you can highlight? What are some of the benefits of this approach?
Thanks, Andrew. Within the Asia context, as you rightly mentioned, over the past 5 years, the flexible workspace sector, has been one of the major demand drivers. And in fact, they've accounted for about 20% of gross leasing demand. In fact, today they're just under 5% of the Grade A stock in the markets that we track within the region. And as you rightly pointed out, both landlords and occupiers are now clued into the benefits of flexibility and what these kind of space offer. So based on feedback from our local market teams, one of the things that we're seeing is a distinct interest from landlords to actually offer fitted out and managed space that they do themselves as part of options when we are looking for options for occupiers in the market. And we also understand that some notable transactions have been completed across the region where the landlord is providing these as part of the service. Landlords are looking at it as a foot in the door to get the occupier to come in to reduce the capex burden for occupiers. So from that sense, landlords are going down the route. Partnerships are something that we are anticipating, and we expect to see that. And we are watching this space very closely.
Joanne, are landlords also taking an increasing interest in flexible workspace in Australia?
Well, yeah, definitely they have to, because occupiers are demanding it. So many tenant briefs now, I think flex space has gone from a nice to have within their building to an absolute must, and therefore landlords have to respond. In Australia, previous to COVID, all the third-party operators were sort of taking direct space. So there hasn't been any partnerships really to talk of, but that's definitely something that we see changing over 2021. We do expect to see joint ventures and partnerships between owners and operators of flex space, as owners definitely look to add it to their building to attract tenants. A lot of what Rakesh was talking about that's happening in Asia. So it's about what model. I'm sure that there will be different models emerge. Which is the right model? We don't know. Is it based on profit? Is it a white label product? But we will see that over 2021. I think another key trend that we might start to see roll out in Australia is that many shopping centres will look to maybe add dead space within their shopping centres and turn that into flexible office space. So, the themes that we're seeing at the moment is occupiers are demanding greater amenity. They're demanding, that flexible option, potentially in non-CBD locations, so in metropolitan locations closer to workforce, and shopping centres can provide that. So that's something that we expect to see will play out also over 2021 and beyond.
Thank you, Joanne. Just continuing that theme, could there actually be an exodus of office occupiers from the CBD to decentralised or metropolitan, as you call them, locations in Australia? And what does that mean for investors? Are they still looking at CBD assets, or has there been a shift towards non-CBD assets? Joanne, why don't you continue on Australia, and then we'll ask Rakesh about Asia.
No problem. Look, there hasn't been many transactions, so there's no clear themes emerging yet. That will happen as we start to see deals actually come to fruition over 2021. There has been, there has been interest from offshore and deals done within metropolitan locations of Sydney, particular places like Macquarie Park and North Sydney. But our view is that the CBD is still prime assets in the CBD is still, will have huge interest, particularly from offshore. We will start to see tenants, renew within those buildings instead of relocate. So, it's all about amenity. It's all about, that flexibility, and we see the CBDs will continue to be the dominant place for occupiers to look, particularly as we start to see incentives will maybe stay higher for longer. We have seen a big increase in incentives over the last 12 months. So occupiers can, a flight to quality is expected to happen. We do see a divergence between prime and secondary space in Australia as tenants do look to sign favourable lease terms for prime buildings.
Thank you. How do you see the situation in Asia, Rakesh?
Andrew, echoing pretty much what Joanne has mentioned. Essentially, CBDs are designed to be the center of activity, and as a result, we see a concentration of infrastructure, amenities, Grade A buildings, as well as transportation nodes. So this is something that is going to be very difficult to change. But saying that, there is interest with for spaces that are outside the CBD, and as Joanne has mentioned, there is a divergence in the in the sort of cost that you would have in the CBD vis-a-vis outside the CBD. So within the region, you're looking at between 20 to 30% difference as you move towards the fringes.
Rental difference, yes.
Rental difference, exactly. And we are seeing some interest in off CBD locations. And recently we heard about a prominent international bank who's offered a third workplace. So in addition to the office and the home, offering serviced offices as option for majority of its staff. And these service offices are going to be closer to residential districts. So we are seeing that kind of interest as a result on the back of that. But I think it's going to be balanced out. As some space moves out into off CBD locations, there will be a flight to quality given the favorable situation for the next 2 to 3 years. So it'll even itself out over this period.
Thank you. So I think our conclusion there is, yes, demand will spread out, but the CBD is not going to die, not by any means. Let's just talk now about our final theme, sustainability and climate change. Across Asia Pacific, national governments are increasingly setting sustainability guidelines for the property and construction sectors. And one factor which has encouraged this and will continue to encourage it is the change in view within the United States. President Biden, the election victor in last year's election, strongly believes in climate change and in the need to address this as an issue. The US has set 2050 as a target year for net zero carbon emissions. You can see in this table here, now that mirrors several Asia Pacific nations, South Korea, Japan, New Zealand, for example. Now, it may be that companies are actually moving faster than countries. Globally, 23% of Fortune 500 enterprises have set 2030 as a target for carbon neutrality, although that proportion is lower in Asia Pacific. What does this mean for occupiers? We think occupiers will need action plans to attain carbon neutrality. New sites will start to require sustainability certifications. For owners, we think it means that ESG, environmental, social, and governance criteria will start spreading in property markets, and new developments will have to focus on sustainability credentials. Rakesh, Joanne, we've mentioned some of the countries which are furthest advanced on the road to net zero carbon emissions, but there are other important markets like Singapore, like Australia, not so well known as a leader in terms of sustainability. Rakesh, how do you see the situation in Asia?
Andrew, you've actually highlighted some of the key markets. China, South Korea, Japan, New Zealand. They've all made commitments towards carbon neutrality by 2050 or later. In the case of Singapore in particular, they've pledged to reduce their peak emissions, which they expect to hit by 2030. So they're expecting to reduce that by half by 2050. India's doing something similar. They're targeting a 30 to 35% reduction on emissions. If you look at the built environment, what we're seeing is in the case of Singapore is targeting to have 80% of its buildings by floor area to be green by 2030, while New Zealand are also targeting net zero buildings by 2030. So in that sense, within the region, Singapore and New Zealand have advanced plans, and advanced targets from a built environment perspective.
Thank you. And even China, we should just mention China, the largest economy in the region, has now a target of 2060 for net zero carbon emissions. That may seem some time away, but it's the first time China has ever set itself a specific target. That was a recent announcement by President Xi. But Joanne, is Australia lagging?
I can't say Australia is lagging, but there hasn't. Australia doesn't have, in terms of clear targets for carbon neutrality. Australia doesn't have anything set in stone at the moment. There has been targets from the government to reduce emissions by around 25-28% by 2030. There has been a lot of talk on this subject in the last 12 months. There's more pressure being placed on our government, considering we are one of the world's largest producers of natural gases and coal. So I do think that there will be some movement with government this year. Hopefully by the end of this year, and the targets, the rumours on targets are looking at about 2050 at the moment. So that's a watch this space. But in terms of sustainability in general, I do think that Australian owners are definitely focused on sustainability, and it is a key theme. I think particularly through this COVID period, there's now a lot of focus on there's a next generation of building, which will include sustainability or new sustainability credentials. It's all about wellness within those buildings, that people can come to office buildings and feel safe. So that is definitely a focus. In terms of what does that mean for owners? I think that obviously being able to spend on current buildings that are lagging in that area will be a key focus. And I do think that the next level of sustainability requirements will drive new developments and drive that next generation of building.
Thank you. And let's ask, what gains can green buildings achieve in terms of higher rent or higher capital value? In simple terms, will the investment required to make buildings sustainable, to make them green, will that investment justify the higher development costs? Rakesh, how do you see the situation?
You know, there's an answer that everyone wants. I'll quote a recent report from the International Finance Corporation. Basically, they estimate the green building investment market, especially for industrial and office properties, to be just under $3 trillion in Asia Pacific over the next 10 years. So it's a big market that we're looking at. They actually quoted a recent study from the World Green Building Council, and some of the benefits are you know, up to 10% increase in rents, up to 12% reduction in your construction costs, you know, up to just under 40% reduction in your operating costs, a 37% price premium, and the ability to sell these buildings on or to transact these buildings much faster. The problem is, you know, this is collated from various, you know, various buildings across the world. What we need to see within the region, and I think this is going to be an ongoing process, is to see more evidence coming out of Asia Pacific, which I think we will build over the next few years, especially, you know, as Singapore and New Zealand and the rest of the countries start hitting their built environment targets.
Interesting. There's one study at least suggesting significant savings from green investment. Joanne, what's your opinion based on Australian experience?
Yeah, I think just touching on what Rakesh said, obviously there is limited data at the moment. It is quite complex because obviously a high sustainable building is going to be, it's a new development, it's going to attract higher rents anyway, higher values. So being able to extrapolate that and when we get more evidence and more data moving forward. But I'd like to echo what Rakesh said. It is about cost savings. I think that's a huge benefit, you know, a reduction of operating costs. And I do think that there is the potential, obviously, to on-sell easier in terms of and an uplift in value because investors will want buildings with high sustainability criteria and green buildings.
Thank you. Well, ladies and gentlemen, thank you very much for listening so far. We'd now like to open the discussion to the audience. Please feel free to raise any questions that you like, and we shall try to answer them. My colleague Danielle, I think, is also on this call, has been collating questions. Danielle, do we have anything so far?
Yes, there's one question so far. What factors or developments could derail the positive scenario for the logistics and industrial sector?
Maybe let me start to answer that, and then I'll ask Rakesh and Joanne for their opinions. But I would say the key factor there is probably the economy. But let's split logistics and industrial into two. If you look at logistics warehouses per se, so that segment of the market, the growth drivers there are very strong. I think Joanne can probably highlight some interesting statistics from Australia about just how much cold chain, for example, is driving that part of the market. So it's hard to see demand for logistics space starting to weaken. Demand for pure industrial space could be affected. It's worth saying most economists predict quite a robust recovery in Asia Pacific economies this year, led by China. If that doesn't happen, then demand for industrial space, pure industrial space, to the extent that it's driven by manufacturing volumes and traded goods volumes, could fall below expectations, and that might affect demand in traditional port markets like Singapore. But Joanne, how do you see this situation?
Yeah, look, it is hard at the moment to see anything derailing the industrial sector. But yeah, as you pointed out, obviously, if there was to be a huge slump in the economy, and if we saw, consumption fall significantly, then we might start to see some impact there to rents and potentially incentives. But apart from that, there really isn't too much there. Australia is definitely a growth market. Industrial, the type of industrial assets that are now required by occupiers, prime next generation industrial buildings, there will be, it is definitely in demand, and there needs to be more development and will be continued development to produce those assets. Strong infrastructure development also in Australia is driving new industrial areas. So yeah, I don't mean to be too positive, but and again, the cold storage logistics, again, we're only at about 2 to 3% of stock, and we expect that to at least double to basically meet demand for our increase in online retail.
Thank you, Joanne. And Rakesh, anything to add to that from an Asian perspective?
From an Asian perspective, what I'd like to say is, touching on cold chain, what's happened over the past year is many of us have been working from, away from the office for most parts, and we've gotten used to the convenience of getting everything delivered to our doorstep. As a result, you're seeing a deep interest in cold chain. For instance, across China, you're seeing a lot of interest from JD.com, from Alibaba, from Tencent in the online grocery and fresh fruit delivery space. You're seeing similar things in India from Reliance and Tata. In Singapore, you're seeing Lazada and Shopee doing the same thing. So, the cold chain sector is definitely growing. And this year, on the back of the vaccination programs, we are really going to see the cold chain sector tested to its limits. So, yes, a prolonged economic slump is the one thing that can derail the sector from where we're sitting now.
Thank you. So I think the conclusion there is we remain pretty optimistic about the sector. We would just watch out for a prolonged economic downturn. And Danielle, any more questions, please?
Yes, we've had a couple more questions. Staying on the logistics theme, do you see industrial and logistics premises with high-tech specs priced properly in terms of yield spread with average industrial and logistics assets? And in which markets do you see the significant price differential?
Sorry, can you repeat that?
Do you see industrial and logistics premises with high-tech specs? Are they priced properly in terms of yield spreads with average industrial and logistics assets? And in which market do you see the significant price differential?
Right. Sorry. So I think that the question is, are the yield spreads offered by industrial and logistics properties appropriate? Could yield continue to fall? Maybe is there sufficient or insufficient difference between high quality grade A properties and older, less high-tech buildings? Maybe just let me express a few opinions here. Colliers produced a major study on logistics warehouses across Asia Pacific in October last year. Australia overall has the region's highest stock of grade A logistics warehouses, and I'm sure Joanne will comment more on this in a moment. But there are other markets which perhaps are leading the way in terms of new trends. Warehouses are going up in height, 5, 6, 7 stories, even higher. That is particularly true in markets like Singapore or the small modern clusters in Japan. Japan has a very high stock of old and not particularly high quality warehouse stock, but the small modern clusters, places like Nagara Yamakashiwa in Chiba Prefecture, or around some of the areas around Osaka, have very high quality stock. So higher more stories, more floor space. One thing you are seeing in China in particular, increasing automation, but also new designs, E-shaped warehouses, U-shaped warehouses, which can have more docking points, allowing volumes to be handled much more quickly and efficiently. In China, prices are quite tight. It will probably continue to tighten. We mentioned early in this discussion, it may be that within 3 years, cap rates for Chinese logistics assets will fall below office cap rates. I think the market perhaps in Asia with the greatest potential for positive prices could well be Japan. Strong demand, limited supply of very limited supply of quality stock. It's a specialized strategy, but I think in Japan you really need to look for development strategies to build and supply higher quality stock, particularly around central Tokyo and around Osaka. Joanne, what's the situation in Australia?
Yeah, look, I think it just comes down at the moment, it's coming down to weight of capital. So, looking at the moment, I think between prime and secondary in Sydney, for example, we're about 90 basis points difference in the yield. We do see that, likely to spread, even though we are forecasting yield compression for both prime and secondary, but we do see the spread increasing to around 100 basis points or more. The weight of capital, 30 billion, looking to seek a place in the industrial sector, and there's been continued capital raising, I think will override some of that divergence, and we will see yields lower for longer in industrial.
Thank you. Maybe Danielle, is there another question? Do we have one more?
Yes, next question. Do you see any changes in the average deal sizes going forward and in lease tenures?
Sorry, changes in lease tenure and?
Do you see any changes in average deal sizes going forward and in lease tenures?
Yield sizes?
Average deal sizes.
Oh, average deal sizes. Sorry, yeah. Sorry.
For the office
deal sizes and lease tenure. Rakesh, maybe start from Asia. Do you see any changes in average? I assume this question is about the office sector, although it may not be, but it sounds as though it's targeted at office. But Rakesh, do you see changes in lease tenure in the Asian office sector?
So over the past year, one of the things that we've noticed, and this is across much of Asia, is we're actually seeing two things. One is landlords adjusting their incentives. So there is more incentives available to occupiers taking up space today. even if you were even if you were leasing space, there is an opportunity to blend and extend or to re-gear your leases. So there is definitely increase in incentives. There's also increase in flexibility. So we're seeing the ability to partially or fully terminate to be added into leases. We're also seeing sublease rights, assignment rights. These typically needed written approvals. Now we are seeing that included as part of lease agreement. So there is flexibility in terms of leases, though tenures are not going down. What's happening is flexibility is increasing. So that is the difference that we're seeing.
Just to add, in terms of deal sizes, I would have to check the latest figures for average sizes, but it's just worth highlighting, according to our global investor survey, 31% of investors in the Asia Pacific region see office as their top asset class, followed by logistics and industrial on 25%, data centers on 11%. So there's clearly still very strong demand for office assets across the region. I would expect that to be particularly focused on block deals where they are available. In some markets, it's difficult to acquire buildings on block, so you have to do strata title deals. Joanne, how do you see deal sizes and lease tenure in Australia?
Yep, just again, echoing what Rakesh said about incentives. So a lot of people, there's talk of shorter lease terms in the market. We're not seeing that eventuate, a strong degree at the moment, maybe within sort of the smaller, the SME market, but really incentive is the driver. So people are willing to, occupiers are willing to, they don't want to give up on that incentive. So they're still willing to sign a longer lease term to capture that incentive. Again, what Rakesh said around flexibility within the lease, we're definitely starting to see that. Break clauses and being able to add in, which we didn't see before, clauses that would deal with a forced issue around occupancy and not being able to occupy the building. And in terms of when I said deal size, I don't know if we're talking about sales volumes or if we're talking about the size of a lease in square meterage. So I'll touch on, since you touched on deal size for transactions. Our inquiry data that we're starting to see in Australia, occupiers have really been on a hold for the last 12 months, but our inquiry data that came through in January really showed a 12% increase on inquiry levels, 12% increase than prior year, the 2019, on inquiry for deals space over 3,000 square meters. So I think there's a lot of pent up demand. There's been no decisions made over the last 12 months, and we might see that start to follow into the market in the next 12 months.
Thank you very much. Well, Danielle, I think we are now running out of time, or we have run out of time. So I think we had better call that question the last. But ladies and gentlemen, thank you very much for joining us today. We hope that was useful for you. If you do have any further questions, or our apologies to people who were not able to raise questions, if you do have any questions, please feel free to contact any of us after this call. Thank you very much, and we hope to be in touch again soon.
Thank you. Thanks, everyone. Thanks, Joanne. Thanks, Andrew.
Thank you, and thank you very, especially to our audience for joining. Thank you. Goodbye.
Thank you. Bye.